Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Wednesday, June 3, 2026. We're Elena and Marcus.
Right. And if you are wondering what happens to your portfolio when a geopolitical shock hits on the exact same day the Federal Reserve signals it might pull away its safety net, well, you are looking at it today.
Correct. We are looking at a market that is suddenly waking up to a much harsher reality. So in today's data deck, we are tracking 4 critical themes that are aggressively reshaping the investment landscape for you.
The first theme we're analyzing is a global stagflationary shock. This is being driven by severe overrate geopolitical escalation in the Middle East.
Right.
And it is a catalyst that has sent the 10-year yield dangerously close to the 4.5% threshold.
Understood. And theme 2 focuses on the resulting equity rotation and the internal flow dynamics. The S&P 500 just broke a 9-day winning streak.
Driven by a combination of rate fears and new White House tariff proposals.
Correct. Which have basically forced capital into heavily defensive postures. Theme 3 looks at the physical commodity squeeze underpinning all of this. We are watching crude oil march steadily toward $100 a barrel.
While gold is making a highly counterintuitive move downward, which actually tells us a great deal about how institutional desks are interpreting this specific type of risk.
Indeed. And finally, theme 4 brings it all together. We are synthesizing these simultaneous moves to map out a broader market transition. The consensus is rapidly shifting from a comfortable soft landing narrative to a much more difficult stagflationary no-landing regime.
Moving to today's data, the primary macro driver reshaping the tape is the overnight military exchange between U.S. forces and Iran.
Right.
U.S. naval assets in the Gulf intercepted Iranian ballistic missiles and drones, which was immediately followed by a retaliatory U.S. strike on an Iranian command center.
The immediate economic consequence of this exchange is that it materially extends the timeline for reopening the Strait of Hormuz. I mean, that corridor has already been effectively closed for over 3 months.
Correct.
We are talking about a choke point that normally handles a massive percentage of global daily oil consumption. When you restrict one of the world's most critical energy arteries for an extended period, rerouting ships around the Cape of Good Hope adds weeks to delivery times.
Right. And it spikes insurance premiums aggressively.
Exactly. And the ripple effects hit the bond market almost instantly because those supply chain costs translate directly into structural inflation.
Indeed. The resulting pressure on U.S. Treasuries today was severe and immediate. The 10-year yield rose 5.2 basis points to just under 4.5%.
Settling at 4.497.
Correct. Simultaneously, the 2-year yield rose 3.9 basis points to roughly 4.08%.
Let's break this curve dynamic down to first principles for anyone currently adjusting their portfolio. Think of the bond market like a car's engine. Short-term rates, like the 2-year yield, represent the RPMs.
Right. How hard the engine is working right now based on immediate Federal Reserve policy.
Correct. Long-term rates, like the 10-year yield, represent the engine temperature, where the whole system is heading over a long drive. Today, we saw a bear steepener, where the spread between the 2-year and 10-year widened by 1.3 basis points.
Understood.
But here is where I want to push back on the initial read. I mean, in a normal growth scare or an impending recession, you typically expect the Fed to cut rates, meaning short-term yields fall.
Right.
Today, both yields rose, and the 10-year rose faster than the 2-year. Why does this specific mechanical move signal long-term inflation fears rather than an immediate recession?
Understood. That is the critical distinction. When the engine temperature, the 10-year yield, spikes faster than the RPMs, it means investors are demanding significantly higher compensation for locking up their capital over the long term.
Because they see inflation eating away at those returns.
Correct. They are looking at the closed Strait of Hormuz and the structural supply chain issues and concluding that sustained inflation is going to erode their future purchasing power. They are actively pricing in an environment where the global economy does not necessarily contract right away, but prices continue to climb indefinitely. That forces interest rates to stay elevated for a prolonged period just to keep inflation from spiraling completely out of control.
We saw that exact anxiety reflected directly in the Federal Reserve commentary this afternoon. The Dallas Fed president, Lori Logan, delivered a notably hawkish pivot around 4:00 p.m. Eastern.
She stated explicitly that higher rates could be needed later this year.
Right, noting that inflation is taking entirely too long to return to the 2% target. and is instead drifting upward toward the mid-twos.
Indeed, her commentary was the most significant central bank communication of the day, primarily because it shifted the tail risk distribution for a potential rate hike.
I mean, just weeks ago, the market assumed the next move was undeniably a cut.
Correct. Now, a hike is back on the table. However, it is vital to contrast her view with the New York Fed President, John Williams, who spoke earlier in the afternoon.
Right, he maintained the monetary policy is exactly in the right place.
Which highlights a severe internal debate fracturing the Fed consensus precisely as these new supply shocks hit the market.
And this fracture isn't just a domestic issue. Looking at the global context in our daily desk data, Bank of Japan Governor Ueda sent a similarly hawkish signal overnight,
Heavily implying a June rate hike is live if upside inflation risks materialize in their domestic economy.
On that point, what is highly notable about the Japanese market reaction is that despite Ueda's hawkish tone, the Nikkei actually rallied 2.5%.
Right.
Concurrently, we saw the US dollar to Japanese yen pairing briefly breach the highly sensitive 160 intervention zone before pulling back. Global funds are continuing to rotate heavily into Japan.
Indeed. They are interpreting the Bank of Japan's normalization process as a sign of underlying economic confidence, aggressively deploying capital there even as the broader global macro picture grows vastly more complex.
Moving to today's data on how those rising yields are transmitting into equity portfolios, we saw immediate and sustained pressure on stocks. The S&P 500 dropped 0.74% to just under 7,554, officially snapping its impressive 9-day winning streak. But if you look beneath the surface, the pain was not distributed equally.
Right. The highly rate-sensitive Russell 2000 took the hardest hit.
Yeah, closing down 1.31%.
Indeed. The specific single stock moves tell a very clear story about heavily elevated expectations violently colliding with the restrictive rate environment. NVIDIA was down 3.6% on the session.
It acted as the single largest mathematical drag on the broader index.
Correct, confirming that the artificial intelligence trade is finally taking a breather after an unrelenting 5-session run.
We also saw severe reactions to corporate earnings. Palo Alto Networks fell 4.4%. Our daily updates show they actually beat the official institutional consensus.
But the stock was punished anyway.
Right. The sell-off occurred because management failed to clear a highly elevated buy-side whisper number that had formed following the stock's 61% year-to-date rally.
Understood. And we observed an identical dynamic in the post-bell action with Broadcom. The stock fell 8% despite reporting a very clean earnings beat.
Which is wild.
Correct. This price action reinforces the broader theme of impossibly high hurdles for mega-cap technology names.
The dynamic feels exactly like an Olympic high jump.
Yeah.
I mean, clearing the bar simply isn't enough anymore if the crowd arrived expecting you to set a new world record.
Right.
When institutional expectations are priced for absolute flawless perfection, even a solid fundamental beat gets sold off heavily.
Indeed. And it wasn't strictly the technology sector absorbing the pain. Open Door Technologies plummeted 11% today.
Yeah, that specific move illustrates the acute pain rippling through housing-adjacent equities as the market reprices the trajectory of long-term rate hikes.
The mechanism is straightforward. Higher 10-year yields instantly translate to higher 30-year mortgage costs.
Right.
That freezes housing transaction volume, severely punishing real estate business models that rely on turnover.
But I'm looking at our desk flows. And to be honest, I'm slightly surprised by the mechanics of the sell-off. With all this headline geopolitical risk and hawkish Fed speak, you would expect absolute panic.
Correct.
Yet, our proprietary updates show the trading floor was only a 5 out of 10 in terms of overall activity. We finished 650 basis points for sale, which is decidedly negative, but it was an orderly grind lower, not a sudden capitulation. Why aren't institutions dumping equities more aggressively?
Understood. The 650 basis points for sale metric indicates that while asset managers and hedge funds were steady net sellers all day, they were unwinding positions methodically.
Rather than indiscriminately dumping assets.
Correct. Furthermore, there was a highly notable buffer deployed in the technology space. The NASDAQ 100 was partially cushioned, only falling 0.29%.
Driven by the Alphabet news, right?
Indeed. This relative outperformance was driven almost entirely by buyers stepping in to support supercap tech following Alphabet's historic $35 billion capital raise.
That stands as the largest U.S. equity capital raise in history.
Correct, and it absorbed a massive amount of institutional liquidity that might otherwise have pressured the broader tape.
We also have to factor in the new White House tariff proposals that hit the tape today. The proposal outlines a 10% tariff on imports from the European Union, Canada, and Mexico.
alongside a steeper 12.5% rate for goods from China, Japan, and Brazil.
Right. This news added a distinct layer of defensive flow to the session. Tariffs essentially act as a direct tax on the consumer,
Further fueling the exact stagflationary environment the bond market is currently pricing in.
On that point, moving to today's data on physical assets, those same inflationary fears punishing the tech sector are originating directly in the commodity markets.
Indeed.
The geopolitical friction in the Middle East is transmitting rapidly into physical pricing. West Texas Intermediate crude jumped 2.3% to settle roughly at $96 a barrel,
While Brent crude reached $98.04.
The underlying supply fundamentals driving this move are severe. Our latest run highlights a report from the Energy Information Administration showing a sixth consecutive weekly draw in U.S. commercial crude supplies.
Correct.
But the detail that really stands out is that this was compounded by an 8 million barrel draw from the Strategic Petroleum Reserve.
Right.
I mean, the SPR is supposed to be an emergency short-term bridge, not a sustained supply replacement. If we are drawing 8 million barrels a week while the Strait of Hormuz remains effectively closed, the U.S. is rapidly running out of policy levers to suppress domestic energy costs.
Indeed. Institutional dealer desks are issuing very clear warnings based on that specific data point. Their assessment is that if the violence in the Middle East continues and the timeline for any potential ceasefire expands further into the future,
Right.
the physical market is going to trade straight through the $100 a barrel threshold sooner rather than later.
This brings up something in today's data deck that seems completely counterintuitive. If geopolitical risk is exploding, missiles are flying, and physical supply lines are under imminent threat,
Yes.
why did gold close down 1.2% today to roughly $4,435? It is now off nearly 17% from its January peak. In any textbook crisis, shouldn't a kinetic war be the ultimate safe haven trigger for gold?
Understood. The price action appears completely contradictory on the surface, but the explanation lies in exactly how the institutional market is classifying this specific crisis.
Okay.
The dominant driver for gold right now isn't the safe haven fear bid, it is the mathematical reality of rising real yields and a firmer U.S. dollar.
Right, with the DXY index up 0.1% today,
Correct.
because physical gold pays you zero yield to hold it.
Indeed. When you operate in an environment where nominal yields are rising aggressively like we saw today with the 10-year approaching 4.5%.
And the dollar is strengthening concurrently.
Correct. Holding a zero-yielding physical asset like gold becomes exceptionally expensive in relative terms. The broader market is treating the Middle East conflict strictly as an inflationary shock rather than a systemic financial panic.
Which means the inflation-driven rate expectations are punishing gold far more effectively than the geopolitical fear is supporting it.
Correct.
Let's synthesize all of these proprietary updates for the listener. We are looking at a tape where physical oil is up, Treasury yields are up, the U.S. dollar is up, but both equities and gold are down.
Right.
What does this simultaneous movement across such diverse asset classes actually dictate about the broader economic regime we are entering?
It signifies a definitive and structural shift toward a stagflationary no-landing scenario.
Right.
For the past 12 months, the market was perfectly priced for a soft landing, meaning inflation would cool down smoothly while economic growth remained stable.
But today's synchronized cross-asset action suggests institutions are rapidly preparing for an environment where economic growth remains stubbornly resilient.
Indeed, but inflation stays highly sticky and elevated.
Driven primarily by these structural energy supply costs.
Correct.
But there is a critical nuance in our data regarding just how severe this environment actually is, and I want to make sure we parse it correctly. Despite the broad equity sell-off and the aggressive rise in rates today, the credit markets are absolutely not panicking.
Right.
Our daily desk data shows that both high-yield and investment-grade corporate ETFs only declined around 0.28%, moving in near-perfect lockstep.
Indeed.
Underneath the hood, our data shows this decline was entirely driven by duration risk, not a blowout in credit spreads. Can you walk through why that distinction is so critical for someone trying to gauge the actual risk of a recession?
On that point, it is the most important distinction in the fixed income market. Duration risk is simply bond math. When underlying treasury yields rise, the price of existing bonds must mathematically fall.
Right, that is what caused the 0.28% decline.
Correct. Credit risk, however, is the fear of corporate default. If we were entering a true recessionary crisis, you would see capital violently flee from lower quality CCC rated debt into safer BAA or government debt.
Investors would demand a massive premium to hold risky corporate bonds.
Indeed, causing credit spreads to widen aggressively. The fact that those spreads are holding perfectly steady tells us that credit investors believe corporations can still service their debt.
So the market is not confirming a systemic stress scenario or an impending wave of corporate defaults yet.
Correct.
Framing the immediate risks, it becomes abundantly clear that the market has lost its Fed put right as an energy supply shock hits.
Right.
Investors can no longer assume the Federal Reserve will rush in to aggressively cut rates to save equity valuations.
Right.
Primarily because Lori Logan just told us they're actively considering doing the exact opposite.
Correct. The critical variables to watch as we navigate this regime shift are Friday's non-farm payrolls report, which currently carries a consensus estimate of 85,000 jobs, and the highly psychological $100 level for West Texas Intermediate crude.
If the payrolls number beats expectations, it fully validates the hawkish Fed pivot we heard today.
Indeed. And if crude breaches $100, it permanently cements the stagflationary pricing model across all asset classes.
And while the broader market is increasingly positioning for $100 oil and entrenched stagflation, we have to consider the structural tail risk on the exact opposite side of this crowded trade.
Right.
I mean, what happens if a sudden, unexpected memorandum of understanding is signed in the Middle East tomorrow morning?
Understood. That is the defining structural question for any portfolio manager right now. Such a binary event could trigger a violent 10% drop in global oil prices almost instantaneously.
That collapse in energy costs would immediately trigger a massive short covering rally in both rates and equities.
Correct. Completely reversing these highly crowded macro trades. It would heavily punish any portfolios that are positioned entirely for a stagflationary outcome without maintaining adequate downside hedging.
To quickly recap today's core takeaways for you, we are seeing long-term Treasury rates rapidly approaching critical technical levels, driven by the hawkish pivot from regional Federal Reserve presidents and structural inflation fears.
Right.
Equities are experiencing an orderly but definitive defensive rotation as the artificial intelligence trade finally takes a breather against impossibly high earnings expectations.
Indeed.
And underneath the entire tape, physical commodities are reacting aggressively to severe geopolitical supply constraints that show zero immediate signs of resolution, effectively removing the Fed's ability to easily stimulate the economy.
Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back tomorrow with the latest market color.